Ladies and gentlemen, good day and welcome to the Q4 and FY26 conference call of PACEDIGITK hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Khushbu Singhania from Go India Advisors. Thank you and over to you, ma'am.
Thank you, Ikra. Good morning, everyone, and welcome to PACEDIGITK earnings call to discuss Q4 and full year FY26 results. We have the senior management of the company on call, Mr. Venugopal Rao Madisetti, Chairman and Managing Director, Mr. Rajavendran P, Chief Financial Officer, and Mr. Ajay Tamble, Head of Investor Relations. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that the company faces. May I now request Mr. Venugopal Rao to take us through the company's operational and strategic highlights for Q4 and full year FY26, along with the business outlook, subsequent to which we can open the floor for Q&A session. Thank you, and over to you, sir.
Thank you. Good morning, everyone. I'm Venugopal, the Chairman and Managing Director of the PACEDIGITK. Welcome for this call. FY26 was a landmark year with successful IPO listing, creating a strong platform for next phase of scale and long-term growth. We have transitioned from a telecom infrastructure execution company into an integrated infrastructure platform across telecom and energy infrastructure and BESS battery energy storage systems. We have built the capabilities across the complete BESS value chain that includes the manufacturing, EPC execution, deployment, and life cycle services. We have operationalized BESS manufacturing facility with installed capacity of 2.5 gigawatt hour during FY26. We have also delivered 178 BESS containers during the last year, which was a record. There is no other company which has manufactured 178 containers within India. We have also successfully executed 480 megawatt of utility scale BESS capacity during the FY26. Machinery, like we have also expanded from 2.5 to 5 gigawatt hour. The machines, the equipment has been arrived. Installation is under progress, and we expect that the 5 gigawatt to be operational from July 26 onwards. In addition to this 5 gigawatt hour, we have also made the plant ready for the 10 gigawatt hour. The construction has been completed. We have also placed the orders for the 5 gigawatt hour lines, and which is expected to be operational in October 2026. What it means is that by October, we would be having a 10 gigawatt hour operational capacity for the BESS. This is actually in ahead of our earlier plans that we thought that first we will operate 5 gigawatt hour and then take the call for the second 5 gigawatt hour. But we have advanced our plans seeing the demand and the order book in mind, and we have already progressed in that direction. And by October, we would be having a 10 gigawatt hour operational capacity. We have also strengthened, all the internal teams. We have built a lot of teams in terms of, managing this 10 gigawatt hour at the manufacturing level, at the field operations level. We have already strengthened. On the telecom side, we are also progressing well. We have also, after to our earlier orders, we have also clocked some orders from BSNL and railways in the last quarter. We also we have secured an order from Railtel for the railway coverage and digital infrastructure projects. We are also strengthening our position beyond this traditional infrastructure from telecom. Which means that in railways we are using it for all the coaches. We are putting the the CC cameras, and then for coverage projects we are coming up with solutions as well. On the growth part, the outlook is going to be very good because we already have the orders in hand, a very healthy order book, coupled with the integrated manufacturing and execution capabilities. We have a strong structured demand across energy and digital infrastructure. We have diversified executable order book of 11,338 crores. The bifurcation of that is in energy sector is 88,554 crores, that is 8,854 crores. On the telecom side, we have the order book of 2,484 crores. And the order book delivered across is the BESS, telecom and OFC and digital infrastructure projects. Our long-term opportunities are emerging from renewable energy integration, where the BESS is required, in a big way. Also, grid stability requirements, BESS is required. And our opportunities come from railways in terms of modernization, digital infrastructure expansions. We are also seeing utility scale storage market in India in a big way because it just started. The growth potential looks very, very solid. Our strategic priorities for the next 2 years would be to scale up this BESS in the C&I in addition to the grid scale BESS, which we are already into now. We are also focusing more on the C&I segment that's called commercial and industrial sector, which means that in the grid scale we use a megawatt scale BESS, whereas in the C&I segment the lower scale, like kilowatt scale, is required. So we are focusing on that. We have already launched some products in that direction, and the certification is also getting through. So we are addressing that market also, which is quite good in terms of quite good and big, keeping in mind the government policies like, for example, Maharashtra, Gujarat, and Rajasthan have launched their BESS policies, and recently, where it says that wherever you have 50 megawatt and above the solar solutions, you need to set up the BESS as mandatory. That would bring a lot of opportunities for the BESS at a C&I segment level as well. The increased contribution from product-led manufacturing, we are also going for, our focus for the next 2 years would be to focus more on the capacity building, as I said, 10 gigawatt hours. So that itself would give us a very good top line. And we would be focusing more on the manufacturing-driven revenues rather than the project-driven, because projects we do already have healthy orders. So our next strategic priority would be to focus on the manufacturing-driven revenues. We also want to improve the operational, we want to, the operating leverage through the integration and scale. That is what we said that, from 2.5 we are scaling up straight away to 10 gigawatt hour, seeing the healthy order book and the demand in the market. We are also expanding our participation across telecom, OFC, and railways and digital infrastructure projects, which will also give us, for telecom also healthy order book and contribution from our top line as well as the bottom line. We do have a confident, long-term growth trajectory supported by strong expansion visibility across telecom and energy businesses. So we are driving this both the sectors parallelly with independent teams so that both can parallelly grow. We are also increasing the contribution from the utility scale BESS projects, which we already have. We are quite we are taking the lead, in fact, in the country where the BESS projects today, our order book is the biggest in the country by any one company. We're also trying to scale up this, integrated manufacturing plan, like where not just the lithium and cell to the container, but the container manufacturing. That means the fabrication of containers also we are going to start in-house, because there are a lot of logistic challenges in terms of, when we buy the containers from outside, transportation and the costs and other things. So we wanted to optimize that. So we are doing the in-house fabrication. The plant is ready. It would be also operationalized from July onwards. So these are our quick summary of the plans that we have. And now over to my CFO on the financial numbers that we have closed yesterday. Thank you. And I'm open for any questions at a later stage. Thank you.
So good morning or good afternoon, everyone. And this is Rajavendan, CFO of PACEDIGITK. So I, on behalf of the management, welcome you all for this Q4 and FY26 full year earnings call. So what I would like to do is that I will take you through the financial and operational performance for Q4 and also the FY26 full year. I'll start with the top line, and then most of my numbers will be consolidated, considering the reason that you all know that as a group we are into the manufacturing and also projects plus services. So on a consolidated turnover for the Q4 first FY26 for this year, we have done 1,096 crores and compared to FY25 the same quarter number of 683 crores, which is a 60.5% year-on-year growth. This particular revenue growth in this quarter is majorly driven by the project execution and considering the healthier order book. For the full year FY26, we have done a turnover of about 2,641 crores compared to 2,438 crores of the last year, which indicates a year-on-year increase of 8.3%. So what has happened in this financial year is that we have a mix of telecom and energy, wherein the energy order book has turned into a top line. So this mix has resulted in a higher turnover compared to the last financial year. When I talk about a segment-wise perspective, which I stated both telecom and energy business. So first of all, the energy contributed to about 78.1% of the total order book, whereas telecom and ICT has an order book of about 21.9%. So on the revenue perspective in the same segment, the telecom has contributed to about 55% to the overall top line, and energy contributed to about 45% of the overall top line. So this reflects a significant growth in the energy business in terms of further diversification from our existing telecom business. So this is all about the top line. Coming to the profitability in terms of the gross profit first. The gross profit for say Q4 of this quarter. So the gross profit is at about 249 crores compared to 129 crores of the last year. The increase is again because of the increase in the turnover. So this is again this particular quarter we had a combination of telecom, energy. Plus in energy we had a combination of both product and the build own operate projects execution. And on the employee expenses going below the gross profit, on the employee expenses for the full year, we are about 95 crores for this financial year compared to 66 crores of this the same employee expenses in the previous year. So there is an increase in the employee expenses considering the fact that now we are diversifying ourselves from telecom to energy, and we have gone on ground to a couple of projects. Plus we have started a BESS manufacturing plant. So this has impacted the employee expenses on the higher side, so which has increased from 66 to 95 crores. So this is in alignment with the company's long-term execution roadmap, the manufacturing expansion plans and the order book visibility. At the EBITDA level, the Q4 number is 163 crores compared to 76 crores of the previous quarter. Yes, again a significant impact because of the top line increase. For the full year, the EBITDA is about 455 crores compared to 481 crores of the last year. There is a dip in the EBITDA level because of the reason that now the composition of the revenues has changed from a telecom oriented to a telecom plus energy combination. So the margins continue to reflect the execution mix and the ongoing investment towards manufacturing and deployment capabilities. So, but however, during over the medium term, we expect operational efficiencies to improve through one, the manufacturing scaling up, two, the localization initiatives as our MD explained. The third, backward integration, which we are already doing. Fourth, improved supply chain efficiencies, and fifth, the increased contribution from the product-led revenues. So on the finance cost side, so the full year finance cost is about 59 crores compared to 115 crores of the last year. So this indicates that the reduction of borrowings and the borrowing cost suppose the IPO and the treasury optimization. In terms of our rating has improved from BBB negative to A negative in the last financial year. So the treasury cost also has come down. On the profit before tax PBT level, FY26 numbers stood at 429 crores as against 283 crores of the last year. Coming to the profit after tax, so for FY26 we are at about 307 crores compared to 279 crores of the last financial year. So which indicates a CAGR of 10.1%. And moreover, this PAT margin is increased. Say in terms of the margin percentage, if I talk about, we are at about 11.4% on the sales compared to 11.3% on the last year PAT over the sales. So this is all about the P&L. So moving to the balance sheet, the total equity has increased to 2,252 crores during this financial year, with the backup of IPO proceeds plus the internal accruals in terms of the reserves and surplus. The total debt as on 31st of March 26 stood about 960 crores compared to 160 crores of the last year. The increase primarily it reflects the investment towards the BESS manufacturing expansion to the energy asset creation, three, the execution scaling up for the energy projects. Third, the next point to note is that on the balance sheet side, we have a comfortable leverage profile. The debt to equity ratio is at about 0.43x. Cash and bank balances stood about 769 crores. The net debt to equity is about 0.09x. On the return on equity for the FY26, it stood about 13.6%, and the return on capital employed is about 14.3%. The return ratio is moderated during the year. Primarily, it is because of the capital deployed towards the long-term energy assets, the manufacturing expansion, and again the execution of the energy projects. From a working capital perspective, 2 points to note. One, on the inventory side, our inventory stood about 540 crores as on 31st of March 26. So this inventory increase is basically the strategic initiative that we have taken, and we have built the inventory for the purpose that considering two different aspects. One, the material cost, which is specifically the lithium ion prices. The second is the exchange rate effect. So to mitigate these two, we have increased the inventory levels as on 31st of March. The inventory is again used in this particular quarter for the consumption. So this has the impact. This will impact in Q1 in terms of the reduction in cost compared to the increased commodity prices. Second, the trade receivables stood at about 2,442 crores. A significant portion of the receivables is associated with the telecom debtors and also the infrastructure project, where the billing is based on the milestones and the retention which is there with the customers. So we continue to focus on this milestone-based billings, which will enable us collections to reduce this debtors level and to further optimize the working capital. Coming to the order book, the total executable order book as on date stood at about 11,337 crores, consisting of energy at about 8,854 crores and telecom at about 2,483 crores. On the manufacturing side, we have operationalized the 2.5 gigawatt hour BESS manufacturing plant last year with approx 80% utilization during the year. We delivered about 178 BESS containers. So now we move to FY27 and 28. We continue to see a strong opportunities across one, the utility scale BESS deployment. Second, the renewable energy integration. Third, the grid stability, infrastructure. Fourth, the telecom modernization. And fifth, the OFC deployment. Based on the current execution visibility and order book, we maintain our guidance of FY27 at about 3,200 to 3,400 crores of top line. And FY28, we target again 4,000 to 4,200 crores of top line. So this is supported by the diversified order book that we have in both telecom and energy being a major contributor to this order book. The company is well positioned for the next phase of stable growth across both telecom and energy being the majority in terms of the order book. So with this, I end my financial presentation and I open the floor for questions. So we are happy to hear from you. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sahil Jinesh Seth from Anand Rathi Institutional Equities. Please go ahead.
Hi, congratulations on the great set of numbers. So my first question would be, our manufacturing capacity commissioning date has been postponed by almost a quarter across all our facilities. Is there any bottleneck we are facing in terms of commissioning?
No. Hi, good morning. Yes, it is delayed by 2 months, I would say, not a quarter. Primarily for this, the shipment got delayed due to this, the conflict in the West Asia. The liners were not ready because they all got stuck on the other side of the sea. So now the equipment has come and it is under installation. We have told you that July will be the operational date. From 1st of July, this line would also be producing the BESS containers.
So, from which country are we importing the manufacturing equipment from?
It's from China.
So, sir, even from China, are we facing any shipping challenges due to the Middle East war?
Yeah. See, I know your point is that problem is on the other side, why the impact is on the eastern part of the world. Basically, these liners, when they work, let's say that they don't just operate from China to India, India to China like that. It is like, to give an example, for example, and our aircrafts, like, from Bangalore to Hyderabad, it goes, from Hyderabad, it goes to Delhi, from Delhi to Jammu, and then comes back like that, So in between, if there's a problem, it impacts the entire, the supply chain or the freight chain of this. So we almost 1 month we lost in terms of the shipment. But the problem is over. Now the equipment is already in our factory and under installation. It will be commissioned within June itself, and it will be operational from July.
Got it, sir. And so my second question is, many players have announced capacity for BESS assembly, the cell to pack manufacturing, which will be commissioned mostly in the later half of this year. Are we planning to backward integrate into cell manufacturing to keep our market share?
See, as you know that we are already in the leading position from cell to the pack and pack to container manufacturing in India. And we would like to maintain this lead by building further capacity, as I mentioned, from 2.5 to 5, and 5 to 10. All of it happening within next 4 to 5 months. By October, we will be 10 gigawatt hours. That is a big capacity compared to others. What people are planning now, but we will have our capacity already built up by September. Whereas others may take some more time, point number 1. Point number 2, it is not just the manufacturing, it is a complete chain. The value chain, if you see, the field operations, you need to have field operations, you need to have business on hand. So today, we have business on hand. The open order book, as we talk now, is 6 gigawatt hour. Order book is there. And then our products are being deployed in the field and they're already working. So this itself is a big learning of almost 1.5 years for us. And everybody has to go through this learning curve. So we will have to maintain that lead, which we are already working on. Point number 1. Point number 2, cell manufacturing. I think it is very much in the cards. Will be coming up soon in terms of the announcement.
Okay, got it, sir. And sir, on the recent China rebate reversal policy, which has already decreased from, I think, 9 to 6% and is set to expire in the next year, what is our current cell cost we are facing and what change are you expecting and how much of would be passed on to our realization on the container side? If you can give us in terms of dollar per kilowatt hour or any number.
Yeah. See, as Rajendran said, so as I explained in my transcript, so what we have done is that as a strategic initiative, we have done some stocking of the cells at the older prices. Yes, you are right. From 1st of April, the rates have increased in terms of this regulatory changes. So the rates have increased almost 20. Sorry, I think the line got disconnected. So I was talking about the inventory filing of 31st of March for this quarter, so which has helped us in terms of reducing the consumption cost for this quarter. But subsequently, we expect that this price has to come down, and moreover, what we have done for all our bidding is that we have kept some contingency factors for all these rate increase, which will take care of our margin protection. So we expect that this price reduction will come from the next quarter. So from there, it has to ease out. So that's what is the expectation from our side.
So can you provide any, in terms of number, what is the current realization per container and what would be the cell cost out of it?
See, normally what happens is that the cell cost is almost 60% of the overall, 60 to 65% of the overall container cost. So the container cost ranges again. Say the current price is about $80.
$82 to $84 is the current trending prices. And the cell is at about $48 to $50 currently, which is on the peak now. And we hope that after this, hopefully this war settles down, and commodity prices should come down because these prices are not sustainable, we believe. But as my CFO mentioned, at least 1 quarter we do not have a much impact, because we already stocked some, materials. So we hope that it will come down. And most of the people, what they're trying to do is to delay the projects in this current scenario. So probably we are not delaying at this moment because we have some stocks. But even if this continues, probably we might have to delay a little bit, because the government also has issued a notification that our guidelines that all the projects can be extended by 2 to 4 months due to this war. We will be using as a force majeure. We might use that if required.
Got it, sir. And the last question, if I may, what savings are you seeing due to our having an in-house container fabrication plant?
Yeah, this is see, there are 2 reasons for this in-house container manufacturing. One, the logistic challenges, are quite big. I'll tell you one example. First of all, in India, the container manufacturing is not, there as of now. There are no small things are happening, but in large scale, for this BESS, we are not finding a suitable partner. Though we are developing 1 or 2, but they are taking more time. So, by and large, we are importing from outside. Now, what is happening is the cost and whatever is the cost of that equipment or the container, almost 30% is the overheads which we are spending to bring it to India by sea freight, and then the other issues in terms of there's some damages and things like that. So it is more of logistics in addition to the cost. Because if we manufacture within our factory, what the advantage is that we will be able to use it for our own consumption. The convenience is very high. In addition to that, yes, there is about at least some 5% to 6% on the overall pricing also. Should be around 4 to 5% could be improved.
Okay, got it, sir. This was very helpful. Thank you and all the best.
Thank you.
Thank you. Next question is from the line of Sanket Sir from Arts AIF. Please go ahead.
Hi team, thank you for the opportunity and congratulations on a good set of numbers. My first question is, our EBITDA margins in the energy segment are slightly lower than the EBITDA margins from Telecom. And in the previous call, you had given an estimate of the PAT margins, becoming around 11% in FY27. So in your view, would those margins, will those margin projections remain intact, or are you expecting some dip in margin in FY27? Given, our order book is mostly in energy.
Yes. Yeah. So your observation is right. And energy sector, energy orders, the EBITDA margins are lower than the telecom. So whatever the order book that we have, the EBITDA margins are comparatively lower than the telecom orders that we have. So with this backdrop, with the energy orders, execution will go up, which is going up in FY27. The margin that you are trying to see in terms of 11.4% of EBITDA, say the PAT margin or the EBITDA margin of about 17.2%, it will slightly reduce in terms of energy order book increasing and the energy contribution to the overall top line increasing. So for the PAT number guidelines, what we can see is that we have a projection of about 10 to 11% is the range that we can give for the next finance, that is FY27, considering the fact that energy is going to play a significant role to the top line of the business.
Okay. And sir, regarding the receivables, which I noticed on the balance sheet, which was just posted last night. So in the FY26 results, it says that the receivables are 1,565 crores. However, when we look at the annual report or the RHP filed by the company last year, the receivables are 1,843 crores. So it's almost a 300 crore difference in receivables. If you could just shed some light on why the difference has occurred.
Yeah, so I think you need to see the complete balance sheet. There is one more line item where there is a reclassification of the receivables into non-current portion. So considering the fact that there is a 5-year project for one of the telecom project, which is from BSNL. So it has a deferment payment of 5 years. So that we have classified as a non-current portion. So that is how we are finding a difference, which is not there in the trade receivable in current portion. It has moved to the non-current portion. So we can see about 292 crores in the non-current portion.
So no, I added the non-current as well as the current portion receivables in the FY26 results balance sheet. And I believe in the RHP and the annual report, there's only one line item, and that is only in the current.
You're right.
So still,
yes, please.
So still, despite that, there's still a difference. If you're able to, give an answer, or maybe I can email you later for this question.
Yeah, so trade receivables, I'll explain. So as I stated, not only for this financial year, for the last financial year also, we have regrouped this portion to a non-current. So it is about 294 crores plus 1,270 crores. So these are the two line items of trade receivables, which is shown in FY25 number in this balance sheet as a comparative number. So it is split into two different line items for the sake of comparison with the FY26 number.
Okay, sir. And my last question is, as you continue to grow in BESS, are you going to continue in the build own operate projects via debt funding only, or are you going to raise through any warrants or a pref round? And rounds as internal accruals do not look sufficient enough to continue funding this expansion.
So, as we stated in our explanation to this financial statement, the current strategy or the strategy for FY 27 and 28 is to increase the product business. So, wherein the product business in terms of this is what we are trying for the external customers. So, with this target or the strategy in mind, what we are trying to do for the BOO project is that there are 4 build-to-operate projects we have, out of which the first 3 are already funded, either through the IPO funds or from the internal accruals. The 4th project is getting funded with the external resources. So with this, we are not stepping into further BOO projects unless otherwise we have some external investment in place. So currently we don't have that plan. So the FY 27-28 we want to concentrate more on the product business in terms of selling it to the outside market.
All right, sir. Understood. And that's it from my end. Thank you, sir, for your time. And all the best.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. We will take our next question from the line of Shreya Kampne from Eloise Financial Services. Please go ahead.
Hello, am I audible?
Yes.
Yes, you are audible.
Hi, sir. This is Shreya. So actually, I wanted to ask whether as it was mentioned about the changes in accounting policies that were going to happen in Lineage Power, your subsidiary. Where I mean, are they being changed, keeping in mind the changes in this area?
See, Lineage Power is a manufacturing entity, and it is manufacturing the battery energy storage systems. So the plant that we have put up, so there the products are manufactured in the name of Lineage Power Private Limited. So we don't have any major significant accounting policy change in the Lineage Power.
Okay.
Yeah. So what not normally happens is that the Lineage Power as a product is either sold to the parent company, which is PACEDIGITK, or sold to the external market. So that's the only difference. Otherwise, there is no major change in the accounting policy.
Got it, sir. Thank you. And also, since the manufacturing facility is more of a assembly, are you immune to whatever technology changes happen, right?
Yes. As of now, we are technology immune in the sense that now we buy the cell as an input for us and we convert that into a product. And then currently, the liquid, LFP we call lithium ion with the liquid electrolyte is the currently popular technology which we are using that. Having said that, we keep working. Our internal, R&D teams are working in terms of, what all the best technologies that are, going on around in the globe, and we keep adopting the technologies till the time we start manufacturing our own cells. But yes, as of now, the technology is not going to impact our business because we buy the cell as an input for our products.
Got it. And also, sir, the revenue guidance that you've given of 3,200 to 3,400 crores for FY 27, is it a net of intra-company transaction?
Yes. So always the top line that we say is net of all the intercompany transactions.
Okay, got it, sir. Thank you so much. I mean, this is from my side. Thank you.
Thank you. Thank you.
Thank you. Next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Yeah, am I audible, sir? Hello?
Yes, sir, you are audible.
Yeah. Thank you very much, sir, for this opportunity. So just first up, I just wanted to understand, this execution of 3,200 to 3,400 and next year around 4,000 to 4,200. So how much of that, in that number, how much is contribution from BO coming through?
You mean to say the build-to-operate model?
Yeah. The BO project, how much is the contribution on each of this year from BO?
So in FY 27, we expect about 25%, 20 to 25% has to come from the BO project.
Mm-hmm. That is about 800 to 1,000 crores.
Yes, correct.
Close to 800 crores. And what about FY28?
FY28, for the FY28, the BOO project may give another 1,000 crores. So that's what is expected.
Okay. And how is the accounting for it? And because this BO project is our subsidiary only, right? So how are we accounting this? Can you just briefly explain?
Yeah. See, it is based on the project to project. So it is based on the project model that is given by the customer. So for the current project which we are executing, it's a MSEDCL project wherein we follow the dealer lessor model as per Ind AS standards. So wherein the project has been classified as a lease accounting model where the revenue and the receivable is recognized. So it differs from project to project based on its structure.
Okay. But largely it's lease accounting.
I'm sorry to interrupt. Deepak, you may please rejoin the queue for more questions.
Okay. Yeah, sure. Thank you.
Thank you. Next question is from the line of Kaushal Sharma from Equinox Capital Venture Private Limited. Please go ahead.
Hi, sir. Am I audible? Very good afternoon, and congratulations for good set of numbers.
Thank you.
Thank you.
Hello. Yeah. So my question on your working capital side, sir, in this current financial year, working capital seems to be stretched out because of the receivables significantly increased. Like our turnover growth is around 8.3% as compared to last year, but receivable has grown 32%. And same side, the payable has also grown for 76%. So what is the reason of increasing the working capital on the receivable side?
Yes, sir. So there are 2 points to note. As I explained, one is the inventory that has been built up specifically for strategic purpose, considering the commodity and the exchange price increase. So we have specifically piled up the stocks on 31st of March for Q1 consumption. This is point number 1. Second is that on the receivable side, what has happened in this financial year is that the sales has been concentrated in Q4. So Q4 we have done a sale of about 1,096 crores. So what normally happens is that for all the projects where the sale is booked, the receivable comes over a span of 90 to 120 days. That's the span that the money gets realized. So the Q4 sales is majorly lying in the receivables. So this is point number 1. Second point is that, as you also stated, that the creditor also increased. So what we normally do is that we try to match the debtors and creditors. If you see the numbers, the net of debtors to creditors is about 650 crores. 650 crores with a 90-day cycle. So that's what is to be seen. So what we do normally is that the creditors we keep with the increased usance period based on the project that we have and based on the customer milestones that we have. And also we have a B2B model wherein most of the customers are again government-based customers with a milestone-based payments. So this accounts for the reason of increased receivables. And to note specifically, as on date, standing on 26th of May, we have already collected about 300 crores for the Q4 sales. From April to May, we have already collected 300 crores. And it is expected to ease out by September 26th.
Got it. And then my question is on your BO model, like we are having 50% BO model. So could you please explain the unit economics, taking the Telangana projects into consideration? What is overall capex, net of VGF and debt to equity mix, IRR and all, EBITDA per megawatt hour, so that I could understand the BO model?
Sure. I'll take an example of, I take the live example of my MSEDCL project, which is from Maharashtra. So the overall cost of the project is about 1.3 to 1.35 crores per megawatt hour. So this includes a GST portion of about 0.2. So leaving this 0.2, the net cost is about I will say it's 1.2 crores per megawatt hour, leaving the GST portion. So this 1.2 crores again includes viability gap funding. Means it's not the cost. So the cost is getting offset with the viability gap funding from the government, which is for about 27 lakhs. So this cost will be offset with this revenue from the government. So 1.2 crores will become 93 lakhs in net. So 93 lakhs is the net cost per megawatt hour, net of GST, net of the VGF funding. So this 93 lakhs per megawatt hour mostly consists of the say the battery storage system as a material cost. And moreover, per megawatt hour, the government, the department pays us in terms of rupees per megawatt hour, not megawatt hour. So say this is a project for about 1,500 megawatt hour, so wherein the revenue will be basis 750 megawatt. So in terms of megawatt, the government pays us 2,19,000 rupees per megawatt per month. So these are the numbers in terms of the unit economics.
And what is IRR in this project?
I'm sorry to interrupt, Mr. Sharma. You may please rejoin the queue for follow-up questions.
Follow-up question of my previous answer.
So the IRR will be about, for the SPV level, the IRR would be about 12 to 13%.
12 to 13%. Got it.
Yes.
Thank you.
Thank you.
Thank you. Next question is from the line of Paras Chheda from Purple One Vertex Ventures. Please go ahead.
Yes, sir. Thank you for this opportunity. I just wanted to understand, in terms of the current outside, what proportion is already billed versus milestone linked versus retention money?
Sir, I think we have missed your question. What is that you're talking about? You're talking about the top line?
Sorry, one second. Sorry.
Your voice is not audible.
Out of the current outstanding receivables that we have, what proportion is already billed versus milestone link that is outstanding versus retention money?
Sir, out of the total outstanding, we have about, say, 5% of this total outstanding is the retention money.
Okay. And the split of the billed versus milestone?
So billed versus milestones, say the milestone-based outstanding, which is yet to be billed, is about 900 crores, which will be billed over a period of next 5 years' time in terms of the GST billing.
Sorry, which will be billed over the period of?
Period of 3 to 5 years' time.
Okay, understood. Because so under the BO project, you mean to say?
No, this is for the telecom project. So we have a milestone-based billing wherein every year, the next 5 years, every year I will be billing about, around 150 to 175 crores.
Understood, sir. So when do we expect the cash flow from operations to turn positive?
Sir, cash flow from operations, this particular financial year, what has happened is that inventory built up plus this receivable built up has impacted this cash flow from operations. We expect this has to get eased out by September 26 because, as I explained, much bigger sales has happened in Q4 of the last financial year, so which has impacted the receivables, so which has to get eased out by September. For this financial year, we are taking care in terms of taking care of the top line to get even quarter on quarter instead of being concentrating on the Q4. So last financial year, sir, what has happened is that the order book that is available with us started executing in Q3, and that's why there is a bulk of sales in Q4. So which will get eased out this year because starting of the year we have a order book which can be where we have already gone on ground for a few projects in this quarter.
Right. So can we expect
FY20? Sorry to interrupt, Paras. Please rejoin for more questions.
No, this is just on that same question. Just one sec. So can we therefore expect FY28 to be CFO positive?
Yes.
Okay,
yes,
correct. Thank you. Yeah, thank you.
Thank you. Next question is from the line of Bhagwat from Prosperity Wealth Management. Please go ahead.
Thank you for the opportunity and congrats on the strong quarterly results. My question is regarding the revenue guidance provided for FY28. Post-commissioning of the ongoing capex, the total base capacity for FY28 would be 10 gigawatt hour. So assuming 5 gigawatt hour utilization for this capacity for base EPC manufacturing, the potential revenue from the base EPC segment itself could be around 6,000 crore at considering 1,200 crore per gigawatt hour. So in addition to this, if we include revenue from telecom and BESS BO segment, the overall revenue guidance of 4,200 crore seems quite conservative. Could you please comment on this, please?
Yeah. Yes, you're right in your observation. So what normally happens is that out of 10 gigawatt, it is not at 100% utilization factor. So it will be in terms of 75 to 80% will be the utilization factor. And moreover, what we are planning is that the BOO projects that whatever we have is about 5.3 gigawatt hour. So that has to get completed. So there the revenue realization would be different project to project. So we expect that the other projects, whatever we have, will have a fixed asset accounting model rather than the lease accounting model. So with that, for this year and the next financial year, majority of the BESS manufacturing will go to this BOO project, and 50% to 60% has to go in terms of the direct product business or the EPC business. So that's how we have arrived at this guideline number of 4,000 crores for the next financial year. FY28. So this would change based on the composition of orders that we execute.
Okay. In the presentation, it's mentioned 2.72 gigawatt hour. So, but you mentioned 6 gigawatt hour. So could you please comment on that?
Total overall is the 6.
Overall 6. Yes.
And the 2.7 is for the, I'll tell you that, there is another, there are out of these 4 BOO projects, 2 of them are, the solar plus BESS, where it is a energy selling business. Whereas the one which we are executing, like MSCDCL and the KPTC is a energy, rental power we call. That means a lease model. So the solar plus BESS may not be, then only the revenue comes from what is the energy we sell. So that will not be counted as revenue. The capex will not be counted as revenue. So all put together, yes, bit conservative numbers we are given, but it is quite possible that we will achieve this, or we may, stretch beyond that also.
Okay, so for FY27, I think the previous comment was 800 crores top line, and next year another 1,000 crore. Is that what I have listened? So on that level, what the contribution it would be from the BO segment for these 2 years?
So BO segment, the 5.3 gigawatt hour I stated is for BO plus EPC in terms of the energy side. For BO alone, it is about 2.7 gigawatt hour. Out of which the first project, which is from MSCDCL, there the revenue is for the current financial year, we will do about 1,000 crores.
Okay, and PAT level, if you could comment what it contributes.
Please take the queue for follow-up questions.
If you could just comment on the PAT level, so that's my the last question.
Yeah.
Just the PAT for the BO segment.
Yeah, the PAT level for the BO segment, the business, overall business, we are trying to maintain at about 10%.
10% of the revenue?
Yeah, 10% of the revenue.
Okay, thank you so much.
Thank you.
Thank you. Next question is from the line of Srinath Panjuranga, an individual investor. Please go ahead.
Yeah, can you hear me? Hello?
Yes.
Yeah, thank you. So, congratulations for the great set of numbers. In the initial remark, you have mentioned regarding Kavach project solutions. Can you throw more light on it?
Yes, sir. So, this is on the telecom and ICT sector. So, as a Kavach project, if you see, the government is trying to take up this initiative for the railway side. So, there are 2 different areas of this Kavach project. One is the hardcore signaling equipment. Second is the infrastructure for the Kavach. So, we are into this infrastructure for the Kavach project, wherein we are trying to provide the network infrastructure for this Kavach. So, we are trying to we have bidded for a couple of projects, and we would be bidding for further projects. So, the railway segment is coming up with these projects in terms of their divisional railways are coming up with these projects in a smaller quantum. So, the quantum ranges anywhere between 100 to 250 crores. So, they are doing it, say, for example, Mumbai to Ahmedabad or Chennai to Bangalore. That's how they take the ranges and they float the tenders. So, we are participating in these tenders because of the reason that we are into the telecom segment and we know this tower structuring and optical fiber laying. So, we are participating in these orders, sir. Yes.
Yeah, thank you. My last question is, now...
I'm sorry to interrupt. We are
now,
not able to hear you. Can you please repeat your question?
It's better now?
Yes.
Hello? Yeah, okay. So currently we have 2.5 gigawatts of 80% capacity, and when we have 10 gigawatts by October, when do you feel we have around 80% capacity for this particular thing?
Yes, sir. Sir, I'm not able to understand your question. Yes, we are expecting 80% capacity utilization for the plant. Overall.
Yeah. By when?
Overall financial year.
Okay.
Yes.
Okay. Thank you. That's all from my end here. Thank you.
Thank you.
Thank you. Next question is from the line of Praveen Sahai from PL Capital. Please go ahead.
Yeah, hi. Thank you for giving the opportunity. My first question is related to your order book related to energy. Can you give the timeline, and second is the revenue recognition for both the segments, like of a solar plus BESS, standalone BESS, and the solar EPC?
So the energy order book stands at about 8,854 crores. So it includes both build to operate and EPC projects. So EPC projects majorly has a timeline of about 1.5 to 2 years in terms of this standalone. If it is a solar mix project, it would be about it would range between 1.5 to 2.5 years. In terms of the BOO, again, if it is a standalone BESS, it will be a timeline of about 1.5 years, and if it is a solar plus BESS, it can range between 2 to 3 years time. In terms of the accounting, the standalone BESS qualifies for the lease accounting, whereas solar plus BESS has to be in terms of the fixed asset accounting. So and it differs project to project based on the structuring of the agreement with the customer. So the accounting treatment would be followed.
Okay. Second question is just a clarification from your earlier, the question related to the receivable of FY25. As per the presentation and as per the, the filing, there is a difference. And if I account non-current and the current receivable together, still there is a gap of 399 crore. So can you give a clarification like where it's accounted for FY25 number?
FY25 number, maybe if you can write a mail to me separately. I'm saying I'm not seeing any differences. It is regrouped between current and non-current. So if you can mail it across to me separately, I can clarify this.
Sure, I'll mail you. That's better. Yeah.
No.
Thank you. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, kindly restrict yourselves to one question only. We will take our next question from the line of Aditya Sharma from Hulani Venture Capital Fund. Please go ahead.
Hello, sir. First of all, congratulations for the excellent set of numbers. Sir, my question is that your energy storage and BESS business is going well. Apart from this, does the company plan to expand into other areas like data center, EV charging?
Yeah. Hi, good afternoon. Data center, yes, because that also is there. Most of the data centers, particularly the AI data centers, are looking for green energy, on a around the clock RTC we call. So we are now our teams are working in terms of their configurations, what kind of power they require. We are working on. Charging stations at the moment, because there is a little retail market, we are more focused on the industrial sector, so probably EV, we are not looking at this point of time. Data centers, yes, the answer is yes.
Okay, thank you, sir.
Thank you.
Thank you. Next question is from the line of Yash Jain from NVS Brokerage. Please go ahead.
Hello.
Yeah, good afternoon.
Yeah, am I audible?
Yeah.
Yeah, good afternoon, sir. Congratulations on a good set of numbers. So, sir, I just had two quick questions. So, sir, first, the NEC Exxon partnership that PACEDIGITK has, which provides PACEDIGITK the exclusive OEM access across the African market. So can you just share the addressable BESS demand across these African markets, and what is the revenue contribution that do you expect from this channel in FY27 and FY28, if any?
Yeah, this is, the NSC is, the group originally is from Japan, and they have a very good setup in Africa, and they have very much, inroads in terms of power infrastructure. So after almost 6 months of deliberations, they have signed up with us as an exclusive for some regions in Africa. They already have some projects which they are trying to, find the financial closure. Once that happens, the order should come. In Africa, like, the addressable market is the grid, the grid is also very unstable in Africa. Most of the countries are, only the power availability is very low. So there is a big opportunity in terms of green energy coupled with, BESS. Yes, FY27 and 28, we do see at least some, around 300 to 500 megawatt hour of orders coming from 27. These are already identified, some 2-3 areas, 2-3 projects which are identified. The teams are working. Probably 300 to 500 is doable in this financial year of FY27. FY28, we might grow a little bit, another 20-25% beyond this 500. This is what our estimates are.
Okay, got it, sir. And my next question is
sorry
like...
to interrupt, Yash. Please rejoin the queue for more questions. Thank you.
Okay, thank you.
We will take our next question from the line of Karthik Mittal, an individual investor. Please go ahead.
Am I audible?
Yes.
So congratulations on the great set of numbers, sir. So my first question is that you said that on an SPV level for the both projects, the project level IRRs are 12 to 13%.
Yes.
So I wanted to know what is the transaction structuring? Like, is the structuring in a manner that the holding company provides EPC services and books EPC profits, and then the subsidiary company books the boot revenues, so that there is some other profits lying in the holding company as well?
Sir, yes, you are right. Considering the fact that PACEDIGITK being a project company, so PACEDIGITK as a parent company will do the EPC of the project for the subsidiary, which should be SPV. So the SPV level, which is the cost to the SPV, the IRR is about 12 to 13%, and there will be a margin for the EPC. Means what we are trying to say is that as a arm's length basis, when somebody else is doing the same SPV, they will be giving the EPC to a third company. So whatever the third company is going to get charged to the SPV, the same price is adopted here also. So what the strength of the company lies in is that the backward integration in terms of this project execution. We don't have a subcontractors in place for the project execution.
Got it. But doesn't it account for extra taxation on the profits you are booking within inside the consolidated entity?
Sir, this is required as an arm's length basis, sir. We need to have an arm's length basis because, as I stated, when somebody else is doing the EPC for the company, he is also going to do at the same price. Only because that we have the capabilities, we are doing this at the parent company level. Yes, with additional margin, that additional margin is having additional tax. These are the standard market practices, sir.
Yeah, got it. Just one more question. You said that currently you are having a first mover advantage in the market, but the other players are also ramping up their capacities. So 1 year from now, what is our right to win the projects? Is it the L1 bidding, or is it the large scale execution capability, or what else?
See, the best business is it's a complete ecosystem building. It's not just the manufacturing. Somebody puts up a plant. It is not that they will get the business. Okay, there are two sets of customers we have. One is the government business. Yes, in the government business, you have to bid and win as L1. That is one opportunity. But whereas in the private business, it is always they look at manufacturing, field operations, and the support available in India, technical knowledge and know-how. All that is very important. For example, our first customer other than our own internal consumption is the L&T. Now, L&T, when earlier they were buying from China, so they have given us the order of 250 megawatt hour somewhere in January. Based on, they have validated many things and then they have given us the project. So it is a complete ecosystem, not just the BESS manufacturing, it also involves PCS, EMS. So we are, first of all, we are supplying a solution, not just a product, one product. So solution coupled with the field services. We have 200 odd engineers who are supporting the field. That also is very much important because the batteries systems don't work, in the field on their own. There are a lot of management and energy management has to be done. That is where we have an upper hand. We have built a NOC and we are monitoring our plants remotely. Entire operations are done online. There is no manual intervention. So these are the things which we also, customers also look at. For example, my first project was commissioned last year, September. So that also will be carrying a credential that, their products are working in the field for more, for a year or so. That also gives a confidence to the customers when they take the business decision. So we believe that we would have that upper hand. Yes, competition will grow because the demand is also growing. But yes, we will have our own share, in my opinion.
Got it, sir. This was all from my side. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, we will take that as the last question for today. I now hand the conference back to the management for closing comments.
Yeah. So we have done a wonderful FY26. We have completed this, and FY27 we are starting with a good order book. So we are confident that the growth that we have and the top line would be achieved in terms of whatever we have projected. So with this, I thank all the investors who have attended these calls and they have put their questions, and hope we have done the answers. And if there is any further questions, they can reach out to our investor relation team. So thank you. Thanks from our side.
Thank you very much for everyone.
Thank you. On behalf of Go India Advisors, that concludes this conference. Thank you all for joining us today, and you may now disconnect your lines.